Hello everyone, welcome to our latest Artemis Live video interview, the latest in our series of discussions with industry leaders from across reinsurance and the ILS market. And today I'm delighted to welcome a senior reinsurance broking sector leader who's going to discuss the performance of global reinsurance underwriting and the opportunities that current market conditions are presenting for both the traditional reinsurance market and also the ILS market's investor base. So joining me today, I have James Vickers, Chairman of Willis Re, the global reinsurance broking unit of Willis Towers Watson. So welcome, James, and thank you for sparing some time for me today.
Steve, thank you very much. Good to be here.
Yeah, it's good to see you, and still all working at home, but hopefully getting back out there soon, we all hope. So Willis Re recently published your latest reinsurance market report, which provides a detailed insight into market capital levels and also some interesting statistics on performance. And I thought to begin perhaps in the context of a reinsurance market that has been seeing more consistent firming of late. Perhaps, James, you could give me a view of how your clients are finding market conditions right now.
Well, Steve, I think it's not easy to make a generalization because the market is firming in different rates, in different territories, in different classes of business. For some clients, they're seeing a fairly gentle increase. They haven't produced much in the way of reinsurance losses. And to be fair, if they look at their reinsurance over a long-term basis, they have enjoyed, certainly over the last 7, 8, maybe 9 years, some fairly substantial rate reductions. So some sort of gentle firming is something that they can cope with and is a reasonable outcome. However, there are some more problematical areas where we're looking now probably the third year of fairly substantial rate increases. And there is becoming a challenge of, can the primary companies pass on these rate increases to their original clients? Is it all getting a little bit too much? But funnily enough, I think the problem is price is always an issue in a firming market, but perhaps some of the more difficult areas have been around coverage, where the reinsurance industry has looked to restrict coverage, particularly on things like pandemic. And in some markets, small minor amounts of cover are still provided. And I think the other area has been difficult or varied a little bit has been some of the silent cyber exclusionary language. So in a hardening market it's not just about price, it is also about terms and conditions and the speed at which the primary underwriters can reflect anything that the reinsurers are asking through into their original policy wording form.
Right. And do you think those discussions on wordings have been constructive over the last year?
I think they have. I think that, some reinsurers have shown more flexibility in understanding of really getting into the detail of, what exactly the original policy form that some of their clients are issuing. Others have been a bit less flexible and just sticking to their guns and demanding blanket exclusions, which in some areas, some of the standard market blanket exclusions, some primary companies have found really just a step too far.
Right. Okay. So looking at reinsurance capital, obviously levels of capital in the industry have bounced back pretty strongly after the pandemic and now look set to rise probably further as well, given the new companies out there and the ILS market also raising some funds, obviously allowing for future losses. Where does Willis Re see these capital levels at the moment, and why do you feel this isn't having the softening effect we've seen in the previous years of inflows?
Well, I mean, the story of capital in 2020 is a fairly remarkable one. We produce our reinsurance market report on a biannual basis, but if we did it quarterly, the figures at the end of March would have been absolutely appalling. There was a substantial loss of capital, which was largely recovered by mid-year, was only marginally down and has recovered again. What's interesting, though, is that, as you rightly point out, this strong capital base is not translating into softening pricing at the front end. And the key reason to that is that when you deconstruct the reported results and the reported ROE that reinsurers are earning, if you take out prior year reserve releases, if you ignore any of the, or you normalize for nat cat losses, the underlying performance, and again ignore investment income, is still very poor. They are not earning a sufficient return on their capital, not yet. Yes, people have spoken about new capital coming into the market, and of course that's true. But it's interesting that 2020 is the second year in the last 10 where reinsurers are actually paying more back to their shareholders through share buybacks and dividends than they've actually earned in net income. So there is this need to keep servicing the capital, even the existing capital. And then to be fair to the new capital that have come in, they've given some fairly strict undertakings to their investors about the types of return that they're going to earn. And with interest rates falling away and showing absolutely no sign of any uptick in not even in the near term, but maybe in the medium term, reinsurers have got to get their combined ratios down into the low 90s in order to then generate sufficient underwriting profit to get to something, at least cover their weighted average cost of capital and maybe a little bit more. So we're not in a classical old hard market, which was capital constrained. We're in a performance constrained market.
Right. Yeah, no, that's interesting. And I was going to ask you, sort of as the underlying sort of result suggests there's still quite a lot of work to do for the reinsurers. How can they gain additional points on the underlying returns? Is it just a case of it's going to have to be premium increase based? And also, how important is this? And you said this, there's new capital in the market, and they've got to keep these new investors satisfied. How important do you feel that is?
Well, the good news is if you deconstruct, which the report does, and we look at the underlying combined ratios, having taken out COVID, adjusted for nat cat losses, and adjusted for prior year reserve releases, there is actually an improvement in the index companies, the portfolio of companies we look at. The underlying combined ratio is getting better, but it's still just over 100%. Now, that, of course, encompasses quite a wide performance within that. You know, some companies are still producing combined ratios in the mid to late 80s and others well over 100. So it is moving in the right direction. So for the reinsurers who've been working away over the last couple of years, driving up pricing, reducing coverage, all the classic steps you would expect in a hardening market, that is beginning to come through, but it's obviously got quite a long way to go yet.
And if we look at expense ratios, which is one of the metrics that you report on, I find particularly interesting, given the different strategies that are out there in the market, they still appear stubbornly high in reinsurance generally when compared to many other sectors. But how do you feel reinsurers can perhaps better manage that going forwards to bring efficiencies both to their own businesses, but also through, more importantly, to their clients as well?
Well, I think there's a couple of things going on there. There's, again, funnily enough, this year, there's been a meaningful reduction in the expense ratio. And some of that is driven by cost measures and increased efficiencies. But the reality, the bulk of it's grown by premium volume growth. The good news is for reinsurers, if they can keep their current cost base as it is, yet grow their top line significantly, that, of course, will drop their expense ratios. But having said that, you know, you're looking over a medium term, we're not going to be in a hardening market forever. So that happy tailwind of increasing premiums leading to reducing expense ratios will tail off, which is why we're seeing a lot of reinsurers looking at ways of reducing operational expenses. There's a lot of talk about, you know, Lloyd's, we've got all the electronic trading initiatives, which will all be helpful. But at the end of the day, those are point here, point there. But growing the top line is probably the most important part of driving down the expense ratio quickly.
Mm. Right, oh, that's interesting. Yeah, I'm a personal fan of the technology initiatives in the market, and I do hope that that will also help reinsurers reduce their cost of capital a little bit more.
Well, I mean, I think the only problem you have to look at is, reinsurers reporting these sort of 28, 30%, 32% expense ratios. Only a very small portion of that is actually tends to be their own directly controllable costs.
Yeah.
I mean, I think some of them, are in 3 or 4% of the expense ratio is their own cost. Um, so it is much more about the chain and the acquisition and how that
Mm,
can work its way through.
absolutely. So moving on to the ILS market for a moment, you said recently that you felt ILS funds and investors had been disciplined at renewals so far this
Hmm.
year. Now, do you anticipate that continuing as we move towards June and July? And what lessons do you think the ILS market has learned over the last 3 years, particularly around managing capital inflows?
Well, there's no reason why it won't continue on the same
Mm,
basis. I think, we have to look at the development of the ILS market over the last 15, 20 years, um, and particularly the sort of explosion that took place in over the last 5, maybe 6, 7 years, when a lot of different structures and different approaches were applied, um, fairly soft market related. And I
mm,
think a lot of the ILS investors, the end investors, some of them have been burnt by some of those structures and some of those approaches, and they've learned a lesson.
mm,
They have learned that in some areas they were undercutting and providing capital at a cheaper price than the traditional market, and that's clearly not a very clever thing to do in the longer term. And then some of the structures that they were supporting have not worked in the way that they thought they would, both for the investors and in quite a lot of cases actually for the clients. So I think it's a much more mature market. And it's no surprise that the tried and trusted, publicly traded cat bonds seem to have come back very much into the fore. There's a lot of investor demand for them. The ones that are being placed in the market, we're seeing that the capacity is easily filled and the pricing is at the bottom end, mostly at the bottom end of the pricing range. And so I think that does show that with the right product, correctly structured, ILS market is really very happy to support. But I think they've learned their lesson on some of the more racy products. And at the other end of it, I think that some of the major reinsurers have become much more sophisticated in their management of their relationship with the end user investors and have built stronger, deeper relationships, which has given those investors more comfort and feeling that they are, in a true long-term partnership, which is helpful for both parties. So I think it's sort of an inevitable, growing up and maturing of the ILS market. And I don't see why, having learned some unpleasant lessons along the way, I don't think they're going to go back to what they did before.
absolutely. Perhaps with talking about sort of the June and July renewals there, you could share with us what your outlook is at this point in time for Willis Re.
Well, I mean, we did our 1st of April market review, and it's pretty much more of the same. We saw at the beginning at 1/1 the way the market was going. It's not softening too much, but then it's not increasing too much, and to some extent, that sort of steady approach to improving market terms is probably helpful because it probably means it'll be more sustainable over a long period of time. Yes, of course, within the market, everything is so much more sophisticated. There are certain classes of business, certain clients, certain territories which are much more distressed, and we're seeing much bigger increases. But generally, you know, the lesson, sadly, of the last sort of hard markets in the early 2000s and maybe post 2005 is very significant rate increases very quickly turn into very significant rate reductions a couple of years down the line. So this more sustainable and steady approach, which can work because we're not in a capital constrained market. I don't really see why there's any particular reason why that would change.
And I think the market is certainly keen to sustain rates at a new sort of level rather than seeing the wild swings that we saw and
Yes.
steep declines. It seems much more healthy for their business models to have a benchmark they can write against.
And I
Do
think the
you?
other thing that's changed is that, 15, 20 years ago, the last sort of hard markets, is the depth of data and
Mm,
analytics that is at the hands of not just the reinsurers, but also the brokers and their clients, and the rating agencies. So, some of those, hopefully those wild swings that we saw in the past will be consigned to history.
absolutely. That's one of the things the broader capital markets
Mm,
found was that as technology improved and data became richer and more available, the
mm,
markets did smooth themselves out, which
mm.
is positive for everyone. And then specifically on the ILS market, do you have a view on how you see the rest of the year panning out? Obviously, hurricane season allowing.
Well, as I said, I think that every time there's some financial crisis, 2008, and then March last year, the well-structured ILS as an investment product keeps proving itself. It does what it says on the tin. It's a good, diversifying, and if it's in publicly traded cap bonds, liquid class of business. So we don't see that there's anything on the horizon which undermines the basic premise that investing in ILS is a good thing if you're a major investor. Um, the issue, I suspect, as always, is going to be keeping the supply and demand in balance and making sure there's not too much supply chasing too little demand, and then we get into underpricing problems and some of the issues of the past.
Yeah, and that's really the job of companies like Willis Towers Watson to go out there and originate more business for everybody to provide the opportunity.
Well, it is, but it's also the original, the buyers, how it fits into their reinsurance strategy, how it
Mm,
works for them. Again, because they're looking to diversify their partners. But I think we've also seen, within the ILS management space, that the investors are much more astute now, and the managers who've managed well and have performed well and kept their clients, well informed of what they're doing and their strategies. No surprise, those are the people who seem to be showing a growth of asset under management. Um,
right.
others, it's more challenging.
Yeah, no, that's great. Thank you, James. Really appreciate you sharing some of your insights
Not at
with me
all.
today. I hope you stay well and look forward to being able to actually catch up with you in person soon.
I hope so very much, Steve. See you soon.
Thanks, James.
Thank you
Bye.
again. Bye bye.